joining us. As I said, today is the launch of our Sustainable Accelerator 4 campaign. As investors in previous Sustainable Accelerators, we're delighted that you've chosen to join us again to hear about our Fund 4. This session will have two parts. The first will be a short introduction to sustainable ventures and our investment thesis, and a summary of our previous three accelerator cohorts. And then the main event will be a discussion with our investment committee members talking about how the coronavirus crisis has affected our current cohorts and how it will shape our investment thesis for this coming fund. And we'll try to leave time at the end for questions from the audience. I think you'll find you're sadly all muted right now, but if you have questions during the course of the presentation, please do type them into the chat box and we will try to get to as many of those as possible. So at Sustainable Ventures, our vision is a world in which climate change and resource scarcity are addressed through commercial solutions. And we do this through a number of ways. We have created an ecosystem to support startups by specializing also in early stage investing in the sector and by providing specialist support services to early stage companies through our innovation services activities, through our workspace provision, and through investment through our accelerator. And we talk about climate change and resource scarcity as our overarching themes, but it can sometimes be hard to contextualize exactly what that means in terms of company activities and sectors. And so we focus specifically on 5 sub-verticals, which you see here on the right: food and agri-tech, mobility, future energy, building technology, and circular economy. We see these as the key thematic areas that will contribute to our vision around solving climate change and resource scarcity. By way of background to the launch of our Fund 4, I wanted to share a little bit with you about our investment thesis. We invest in and accelerate a diverse portfolio of early stage SEIS and EIS sustainability businesses. And our investment thesis is fourfold. First of all, de-risking. We believe that our experience in the sector and the specialist support program that we provide to all the companies we invest in de-risk startups through their early and often most challenging growth phases. Testament to that is our Fund 1, where the companies in that fund have raised money at an average 4 times valuation uplift from our initial investment. We also focus on deal flow and diversification. Our network of startups, including the startups in our Sustainable Workspaces community, as well as the companies that we meet through our other incubator programs, gives us a proprietary deal flow and early access to some of the most disruptive businesses in the sector. And this allows us to invest in a high quality pipeline and create a strong and diversified portfolio. Fourth, we have the power of leverage through early stage investing with SEIS and EIS tax benefits, as well as leveraging the significant government grant funding available in this sector. Both of those creating leverage from early stage pre-seed investing and protection on investor downside risks through the tax benefits. And fourth, we focused on capturing value early. So investing early allows us to take equity stakes just prior to growth inflection points, really at an early stage in companies. And this often provides greater appreciation than later stage VC or private equity comparables. Just wanted to give a little bit of highlights to our previous 3 funds. So many of you will be investors in these funds. To date, we've invested 3 funds, a total of £2.4 million into 22 investments. Those 22 investments have gone on to secure 23 million in further funding, a figure that we're really proud of. In terms of highlights, there are so many to choose from, but I just wanted to give a couple of examples, maybe one from each fund. So in Fund 1, the the 2017-2018 fund, this has been performing really well, and the companies in there have gone on to raise 17.5 million in funding since our first investment, which took place in October 2017. Just to mention one company from that portfolio that's really been doing well of late, that's Good Club, online sustainable grocery, also looking to introduce a closed-loop packaging solution. They've recently closed a £1 million funding round, largely off the back of a huge spike in demand resulting from the kind of stay at home through the lockdown. In Fund 2, that's our 2018 accelerator, also performing well. Just one example, Zygo, our PPA energy business, that's been progressing extremely well. They've signed 18 corporate clients, including Gatwick Airport, Network Rail, and recently closed a seed round of just under £1 million. And then our Fund 3, our most recent fund, raised at the end of last year. This cohort's at a much earlier stage in terms of time with us and commercial growth, but it's showing very promising early signs. 5 companies already achieved revenues, and recently a number of companies been successful in grant bids to provide additional funding, including Thermilon, Minviro and Sunswap. On the commercialization side, Vendi have launched a new partnership with the Mobile Network 3, and Tandem have been showing strong journey growth numbers for their aggregated journey supply in spite of a pandemic, as companies seek to get their workforces to site safely. So this event is about launching our Fund 4, which we privately launched today. Hopefully you've all received an email about that. If you want to find out more details about the fund and to see the prospectus documents, please do log on to the CEDARS site, so cedars.com/SA4. This funding round will be open from today through to early December. Through November and December, we'll aim to hold pitch events for prospective investments and then to start making investments from early 2021. In lieu of a kind of full Meet the Portfolio event, which we like to run every year, but obviously this year very challenging, we'll be instead running a number of webinar event evenings held on Thursday evenings like this one to meet portfolio companies and to meet the investment team. So next week on Thursday the 8th, we'll have a Meet the Portfolio Companies event where we'll have a group of companies from across the previous 3 funds. And the following Thursday, 2 weeks from today, we'll also be running a similar session to this one, so a Meet the Team event and talk about the subject of Build Back Better. And we'll advertise further Thursday evening events as we get closer to the time. So without further ado, I'd like to move on to the main event, the panel discussion section of the evening. I'm delighted that we have all 3 of the Sustainable Accelerator Investment Committee with us. I think in our prospectus document, we advertised 100+ years of investing experience. So it just goes to show the depth of experience in investing in early stage businesses. So Andrew Wordsworth and Chris Morris, the co-founders of Sustainable Ventures, and Peter Short, our Chief Investment Officer. All 3 of them experts in sustainability in the startup space, and I'm really looking forward to hearing their thoughts as we go through the question section. So panel, are you with me? If you can maybe give us a wave. There we go. Very brilliant. Okay, so this has obviously been a very strange and unexpected year. And I think when the impact of the virus hit the UK in earnest with the lockdown, many of us had real fears for the impact that would have on the startup community in general, and clearly closest to home on our own portfolio. 6 months on or in, I wanted to ask each of you your personal views on how the Sustainable Accelerator companies have responded in the face of the crisis. I think, Andrew, we're going to start with you because I have a high-tech alphabetical process for you.
Certainly. I'll just pick up on your theme of community, and I think sort of looking back, what really struck me was how at the startup community we created, both including obviously the 22 investments, came together and really moved forwards as a group. Looking back at sort of April and May, we were actually sort of able to bring those groups together. At one stage, we were running at least 2 webinars a week, and specifically focused on kind of access to government support schemes. So, how to execute the furlough scheme, looking at future fund, bringing in our network of professional advisors to provide HR advice or be able to sort of discuss those things and provide that kind of coaching. And we're typically getting probably about 70% of the 3 accelerator cohorts coming to do that. But we sort of went beyond that sort of coaching and really sort of worked with them to secure that government support. So whether that was R&D tax credits, obviously many of you will be aware the Innovate UK stepped up their support in terms of the grants that were there, a number of the portfolio companies were successful in securing those grants, and we were able to sort of help review those bids and sort of polish them to that point. It's interesting, I was talking to Thermalon this morning, who said actually they've got more money in their bank account than when they closed the round in early April, because Innovate UK have been advance funding things or paying match fees, and they've done extremely well, and actually their runway's longer as a result of since the start of the crisis. Other companies that we were actively supporting, a couple, I think Circular, who was sort of focused on sort of travel and hospitality sector, obviously faced a little bit of those are 2 of the hardest hit sectors, but it's really been able to sort of work with companies like that, and they opened an online retail shop, and continuing to sort of completely pivoted the business, and similarly with New Wardrobe, again sort of sharing of fashion, and they've entered they're doing very, very well in a current crowdfunding round. So I think that was it, and I think the fact that we were able to sort of bring people together, we were able to apply some of the expertise that we have in sustainable ventures, so really pleased that a lot of the companies were more resilient as a result.
Yeah, thank you, Andrew. I remember those first weeks when we all had to become experts in furloughing and CBILS loans and future funds, as well as talking with our companies about how to manage costs and manage suppliers. And I think it was a real period of all of us coming together to support the community. Chris, I wonder if I could turn to you and ask you the same question. What have been your observations about how the portfolios responded to very strange times?
Absolutely. I'd certainly echo what Andrew's just said. First of all, this crisis has provided us with an opportunity to prove our worth, that's for sure, and make sure that across the portfolio companies, people were taking smart decisions quickly and making the most of the wide-ranging support that has been on offer from the government. But many of our portfolio, I feel, have actually been able to do much better than that and go as far as being a real part of the solution and becoming much stronger as businesses themselves as a result. Good Club, who you mentioned earlier, Susanna, for instance, the online grocery business that we invested in back in Fund 1, saw sales treble in the early days of the lockdown as they provided essential access to much needed goods, and they've been able to parlay that into ongoing sustainable growth and as you mentioned, a 7-figure follow-on funding round and are in a stronger position than ever. Then you have HireCar, the peer-to-peer car sharing operator that we closed, I think, our most recent investment into actually, who've arguably played an even more important role in providing private transport to NHS workers so they could travel safely to work. using a shared asset. And more recently, providing a sustainable, affordable alternative to public transport for others who need to get to work or elsewhere, but rightly don't want to risk spreading the virus. And then the third example I'd like to give is Petit Pli, who, as designers of children's clothes, you might think haven't particularly had a role to play here, but who have in fact rapidly turned to using their incredible pleated fabrics to create comfortable, flexible and beautifully designed face masks, and again are actually in a stronger position than they were 6 months ago. And those are just a few examples, really. All in all, I'm quite proud of our portfolio and what they've achieved and the impacts they've been able to have over the last 6 months, whilst not compromising on their principles economically either.
Thank you very much. Yeah, some really good examples. I think there's a lot of Petit Pli masks in our office right now. Chris, sorry, Chris.
They're sold out. I haven't been able to get my hands on one.
I think they've just launched a new batch, actually, so you need to get in there.
Get on that. Thank you.
Yeah, other masks are available. Peter, I wonder if I could turn to you and ask the same question: what your observations have been about how the portfolio has responded.
I'll address some of those thoughts in a second, but one of the things that I was most concerned about in the early days of the lockdown was whether we as investors would be able to maintain an appropriate level of due diligence and professionalism in our approach to doing transactions. And secondly, whether we'd be able to maintain the level of support to the companies, which is sort of underpins our investment thesis. And both Chris and Andrew have spoken about how we've managed to directly aid companies to address the challenges around COVID and accessing government support and other schemes. But I think it's important that we don't lose sight of the fact that, you know, our investment thesis is predicated in the fact that at some point this COVID business will go away. And we have to have developed strong and successful businesses that keep going. So, I mean, firstly, I was to go back into sort of March, April, when we had our first sort of virtual investment committee, and I was sort of struck by how well that worked, and how well we'd been able to complete the due diligence and the paperwork and get good quality case files developed, and you know, actually just do it, you know, all the boring but vital stuff of just making sure that the transaction was well funded, and that was really encouraging. And we've managed to keep up a regular weekly pace of our Monday afternoon investment committees, which I think has been critical to keeping us going. And you know, we've made investments through this period. We've kept the drumbeat of activity going. I think we've made some very good investments. So I think, you know, that I know sometimes it sounds a bit like stating the blindingly obvious, but you know, if you have a fund and a cohort, you've got to keep the work going, and you've got to get it done well. And I think we've been able to do that, and that was a big worry, but it's one that I don't have anymore. The second point I actually also think was delivering the accelerator support to the businesses that we've brought into both the new portfolio and the second cohort. Again, you know, in order to build value, we've got to keep being able to deliver the support proposition, and we've done that. And you know, a number of us, for example, were on two calls yesterday with two companies in the portfolio about building their board and their governance strength, all of which is not directly related to dealing with the COVID-19 situation, but will build long-term value in these companies, because when we come, one of the reasons I think we've done well in earlier portfolio companies fundraising, second and third round fundraisings, is that they're well-run companies, and investors come in and they see that they're able to produce good quality due diligence information, they're able to produce good quality pitches, and a lot of that's down to the support that we've been able to give them. So I think the fact that we've maintained both the pace and the quality of the investment process, but also maintained the general support and the general level of support at a high quality, I think is really encouraging. But there are a lot of upsides, but equally, this event we would normally have in our premises. You might have to drink some lukewarm Chardonnay, but you get at least the advantage of face to face, and we have to just work that bit harder to overcome the problems of working distantly, and it would be naive to say that doesn't require an additional level of discipline. Thanks.
Yeah, I remember in fact the way it happened is that although we had well-developed transactions in the pipeline, we actually had not completed on any of our transactions until lockdown started. I think we did the first 4 in that March-April period, and I remember immediately having to go back to all of the companies and saying, okay, we want a full COVID risk assessment. How quickly that all happened, and to the credit of the startups, how well they responded to that.
Yeah.
Great. I'm going to move on now to another question. So Build Back Better has become kind of an unofficial slogan of the recovery, and neatly brings together both the needs to address the economic downturn created by COVID, but also, much more importantly, the longer term climate crisis. And as we look to raising and investing in our 4th fund, we know the world has changed. We, all I think believe we want to build back better. How will you shape your investment thesis, or how will we shape our investment thesis for this new fund in light of the COVID crisis? Andrew, we're going to come back to you.
Okay, fine. I think since we launched Sustainable Ventures in 2011, our mission has remained unchanged. It should deliver the world's leading sustainability businesses and commercial solutions to the twin challenges of climate change and resource scarcity. That, I think, is more relevant than ever. I think despite the crisis, I think the kind of almost driven by the consumers and consumer awareness that this transition to a sort of net zero economy is almost inevitable. And I think we're seeing that in our discussions with from investors through to government, through to corporates and consumers themselves. Having said that, we can't ignore the fact that it's going to be could well be a tough old economic position. So yeah, we will focus ever more intensively on value proposition and business model innovation. We will continue with our thesis of capital efficiency. So although it's a small seed stage fund, we are looking for, we're very unlikely to invest into what I call big box technologies that need a massive amount of capital to sort of get themselves to market. Having said that, if you look at the various portfolios, we have tried to include companies such as Drygrow, for example, which we think is a sort of very modular, scalable design, which will need slightly more capital. But as Sean said, they've raised 5 million, but at a significantly increased valuation, which has kind of preserved our stake. So I think, it's going to be faster, better solutions. It's going to be informed by some of the work we're doing elsewhere in Sustainable Ventures with corporates, identifying what they're looking for and feeding that back into companies that will ultimately meet their demands and the demands of their customers. So I think that's so I think that's it all seems to be accelerating at a pace.
Thanks, Andrew. And Chris, if we could turn to you.
Certainly. Yeah, I think I've been really quite pleasantly surprised by the extent to which individuals, businesses, and the financial markets have continued to recognise the importance of sustainability, regardless of the seismic impact that the pandemic is having. I think if you were to look at kind of press column inches at the moment, you've got COVID-19, you've got Brexit, and then there's not a huge amount of oxygen left for anything else, you'd have thought. But I think the one real exception to that is notions of climate change and resource scarcity, which are of such global significance that they aren't being drowned out by the wider noise. And if anything, are climbing up people's totem pole again as we begin to think about the future that we want. That said, we will be looking particularly at sectors and business models which are either part of the COVID-19 solution or which are going to be well aligned with the kind of wider themes and meta trends that we think the pandemic will drive. So a few of the themes I've been looking at in particular include localism or relocalism, particularly in the food supply chain. Micro-mobility, which obviously isn't new, but which is set to gain, I think, a new wave of traction as our transport network changes, in part due to COVID-19. Variety of virtual or flexible service models, building on the kind of wider themes of digitalization, which have obviously been a kind of meta trend across all sectors. Ultimately, I'm quite excited by the opportunities we have here to continue to deliver superior returns whilst helping build the world that we all want to return to as this pandemic ultimately passes, as it obviously will.
Yeah, some great sectors there. I think, you know, I have really noticed the food and agri-tech part, people wanting food, their access to their food closer to home. They want to grow their food closer to home. They want to know that it has come locally, and I think there's a lot of things that we can do there. Peter, absolutely not least, although last.
No, actually, it's interesting. I was listening with extreme interest to what Chris was saying, because it sort of reminded me of how the world has changed, actually. And I was reminded, you know, when I sort of was one of the founder directors of Carbon Trust back in 2001, the narrative around, I mean, just one technology sector, for example, the narrative around offshore wind. We spent a lot of time and money, and both Andrew and Chris remember this, I mean, looking at the economics of offshore wind, and it was dreadful. It was dreadful. And we were all going, gosh, how is this ever going to become a mainstream business? And, you know, at that level, it was quite depressing. And now, actually, you know, we look at some of our, you know, two of our really quite successful businesses, you know, Rovco, well, others actually, but I'm just mentioning two, Rovco and Senin, both of whom are, you know, different types. You know, one's a software service, the other's you know, an operations service, but are making really good business in very, you know, a very novel, what was 20 years ago a very novel space, but is now mainstream. And I think we're going to see a lot of that, and I think we're going to see a lot of the companies we're looking at over time mainstream, and I think that's really important, and that leaks back into the views of investors. You know, and as Chris said, you know, the narrative in the media, you know, the one bit that's not being drowned out is around sustainability and the move away from sort of carbon-based fuels, and that's really interesting. In terms of what we're looking for, I think what we're seeing is that the investment markets and the follow-on funding markets have not closed. And again, that was a real fear of mine back in March, April. You know, that we would not be seeing second round and third round fundings being done over the period. In fact, we are. You know, but again, it comes back to the really old-fashioned sort of things. You know, good management teams with, you know, operating in sectors with the potential for high margins, and in, you know, long-term markets that and spaces that are growing, they get investment. and they get investment at good valuations. I mean, there is really no rocket science to that. You know, it's the sort of stuff we've been banging on about for years, but it hasn't, you know, the current situation, however trying, has not made that, you know, made that go away and made the old disciplines any less relevant. In terms of where I'd like to see, somebody else has already mentioned, but I'd like to see more in agri-tech. I think there's a lot to be done there. And I think there are a lot more businesses there. I think also we need to see more in genuine circular economy businesses, and I think there are opportunities there. But you know, the advantage of the way we approach it is these are about cohorts and they're about diversification. Because if there's one thing we have learned, or at least I've learned over the last sort of 3-4 years doing this, is it's really, really hard on day one to be absolutely certain about which of your investment's going to win and which one's going to lose. Which says to me, diversify, build a portfolio, spread it over sectors, because that's how you manage risk. And I think that's core to our proposition. Thanks.
Thank you very much. We've actually had our first question in from someone. Actually, it's 2 questions, but I think it's from the same person. So what does the panel think about the environmental bill going through government at the moment? And second question, other than the obvious areas, masks and transport, what other areas are the largest areas for growth with respect to sustainability innovation? Gosh, I don't know who wants to jump in. So the first question is about the environmental bill going through government. That feels like a Chris question. I don't know why.
You reckon, do you? I think I'll probably start with the second question, to be honest, to focus on specific sectors that I think we expect to see real growth in directly as a result of the pandemic. And yes, there are some obvious ones such as transport and kind of PPE, etc. in the very near term that the question asker has mentioned. But I think actually we're much more interested in the long-term trends. We think this is going to accelerate rather than short-term opportunities. As Peter said, we're building a portfolio for the future here. And that's why I think food production and agri-tech is high up the list. And I do think that is linked to the pandemic, because people are now much more mindful about the security of their supply chain in essential sectors, and that is driving localism in all sorts of ways in that supply chain in particular. So that's sort of my kind of number one focus. And then I think whilst I'm not particularly interested in trying to compete with the likes of Zoom and Google Hangouts and the obvious video conferencing providers out there, I do think there is going to be a wave of software businesses that enable interaction in various niche markets that are inherently much more efficient and actually do adapt well to working patterns that I think are going to emerge off the back of the pandemic. I think that there's a big discussion to be had over how much this is going to happen, but I don't think we are going to see all businesses returning to 100% in the office, and therefore the ability to manage specialist transactions or collaborate in particular ways, share information, and indeed actually do business, provide particular services in a different way online is going to be a big trend. So those are the 2 sort of big areas for me. But I think it's really important that we don't make any knee-jerk reaction decisions here. We will not be investing in a mask company, for instance, because not really interested in maybe making a little bit of money on the downslope of a very short-term trend.
But I guess in the case of Petit Plis, we did have a circular economy clothing company using their end-of-line material to produce masks, which was a nice response.
Yeah, and I'm certainly not saying that companies shouldn't be opportunistic and shouldn't adapt. They absolutely should, whilst at the same time making sure they're building real sustainable competitive advantage for the future.
Thank you. I wonder if I could ask Peter the same question.
It's interesting. I think one of the real changes that we're going to see is how one goes about managing and running businesses in a sort of a distanced environment. Whether this produces investment opportunities or not, I don't know. But I think it's something that we're all going to have to think about. It's a very, I think we have learned, it's a very different thing running a complex business, even if it's only relatively small numbers of people, but doing high intellectual added value stuff in a distributed way. And there are issues there around training, there are issues around onboarding, there are issues there around developing and training staff. And I think we need to think about that, and I think all our businesses need to think about that. And I haven't seen them yet, but I'm sure there will be commercial opportunities that come out of that. Whether they fit in our remit or not, I don't know. So that's more of a generic response to a change in the way we're going to be doing business. And I think that whilst, you know, I think we will get back to something more like pre-COVID normal, I don't think we're ever going to get back to it exactly as it was. So there will be opportunities that will come out of that. And I think we need to look at those, and we need, when we're doing our basic due diligence on business opportunities, we need to reflect quite carefully on how the management teams are responding to that. We're seeing that in some of our businesses, and perhaps we're seeing it less in some of the others. But in terms of other sectors, I mean, I'm going to go back to, I think we need to see more good businesses developing in the circularity space, because I think there will be opportunities there, and I think we will be seeing increased pressure through regulation on that sort of space. So I'd be surprised if we didn't see some stuff there.
And on that point about regulation, there was a question around government bills, and I might let you off, Peter, and give Andrew a chance to share with us his thoughts on just kind of the regulatory direction in general, because obviously it's an area of increased focus from government and regulation, and that directly impacts kind of the types of businesses and the focus of businesses in our sector.
Yes, and I think one of the kind of key interesting features of the sector is it's a lot closer to like the regulatory environment and sort of the interaction with government, partly because you excuse the kind of carbon trust language, the companies that we're investing in helping build are delivering against kind of public good objectives, and because of that, there's always been support and a regulatory environment. And I think they should us to think of 2002 when we joined the Carbon Trust. That was almost at that sort of that intersection, and what that gives us is that kind of comfort, if you like, with regulation, and therefore I would say, I always look at the environmental bill, but also say the broader direction that the government policy and bills are going in. Basically, it creates a sort of opportunity, because they sometimes could force a step change in the sector. They can force people to take further steps to make emissions reductions, to for example, the Green Home Improvement Grant that launched today, it creates opportunities for companies who are selling energy efficiency goods and services into that sector, and so yeah, and I think what's interesting is it very much seems to me, certainly in the UK, there is this cross-party consensus that things must be done. There's almost people outbidding each other to when do we get to net zero? When's the ban on electric? When the ban on petrol and diesel engines going to come through. And you can see that as we talked about the offshore wind sector. If you take a view to sort of 2035, 24, it's not a surprise that has driven a huge valuation uplift in Tesla, because it's they're ahead of the curve, and that they are going to be they're in sort of pole position to sort of capture that value. So I guess what we've sort of built up is you've got to look, you need to take that slightly longer term view, and that's what drives what seed investment opportunities are to you now.
Can I just say, because we've got a really, really good example of that in portfolio 3, which is Minviro, which is a business. It's a data analytics business, and its proposition is to help investors in mining companies model and gauge the environmental impact of mining extractive activities. At one level, that sounds quite environmentally destructive, but one of their primary markets is into the lithium business. And if you want Teslas, if you want electric cars, the batteries are going to be lithium, and you need to come up with a way of ensuring that lithium is extracted in as environmentally benign a way as possible. So, it may seem a long step from a huge business like Tesla to one of the companies in our portfolio, but it's actually all part of the same, the same movement towards a lower carbon economy.
Yeah, great. Thank you. We've had another question, and I'm keen to have time to get to it. Again, it's a multi-part question. We've got some very inquisitive audience members. So the theme is around what are your views on institutional investors coming down into earlier stage profile in terms of investing, and do you see corporates and CVCs thinking about helping more at the startup and seed stage, particularly given the thesis that we should all be helping out more equally and providing some more structural support in the economy? And the third part of that question is, do you think the pandemic increases the number of businesses founded or spun out in the medium term? Is there opportunity from adversity? I think that question is about. Maybe Peter, you could address the point about later stage investors coming perhaps earlier into the investing process.
I don't know. The trouble is, it's very difficult to make a generalization about behavior of later stage investors. Even more, it's difficult to make a generalization about the behavior of corporate investors. We've seen funds like Sky Ocean Plastics coming in and supporting some of our businesses. We've seen other investors, frankly, sitting on, institutional investors sitting on their hands. I think, will it make a big difference? I think it'll slow things down for 6 months or so, and then it will go back to sort of where it was. And that's a dangerous thing, because that's a prediction. But do I think that in the UK we're going to see the sort of behavior one sees from some of the classic Silicon Valley investors of starting to invest very small and following the money all the way through? I don't think we are. I wish we were, but I don't think that's going to happen. So I think we're always going to see Death Valley gaps, or whatever the current term is, where it's too big for angels, it's too small for institutions, and I would always press some of my former colleagues at British Business Bank to do something more interesting about that, and maybe someday they will.
Thank you, Peter. So there was another part of the question about CVCs, and Andrew, you spend a lot of your time talking to corporates, engaging with corporates around early stage innovation and how that plays into the supply chain and development in corporate. So I wonder if you could give a view on that.
Yeah, sure. I think our feeling is that the CVCs which seem to have come back into fashion. So certainly in the energy sector, pretty much all the utilities have a CVC, but they generally they don't come down much below sort of, let's say, 2 million in terms of an investment, strategic investment, and probably much later stage, sort of 3 or 4 years often after we would come in. But the good thing is, I say, because there's growing interest, because people, they're in their own rights, those companies have got to address how they reduce their emissions, how they help their customers reduce their emissions, and that creates a sort of a target to aim for. And yeah, I can see the liquidity and the investment appetite growing at that sort of stage, which because one of the key things we do is look for that funding path. So we won't make a seed investment if we can't see how it can get through that sort of late stage seed round into a round into a CVC. Then we won't invest on a road to nowhere. But increasingly, we're seeing also corporates. We've got a program with Schneider Electric, which is the Net Zero Home Challenge. And that's where they're working with companies at a slightly earlier stage than they would typically invest, because they want to sort of work with them, get to know them, basically build them into their solution. And that's creating a sort of great sort of get to know you type of opportunity, which ultimately is almost certainly going to lead to acquisitions from those companies. So although it's not an accelerator activity, that's a complementary activity that we're increasing on the Sustainable Ventures side, again, to create those kind of exit opportunities for the companies in our investment portfolio.
Thanks, Andrew. I know we're running a little over time, but we've got a juicy question in from Rod about I think the question is hydrogen versus battery for EVs, and as our resident EV expert amongst other things, Chris, I'll ask you to give your thoughts on that.
Sure. Okay. So the question is what we think of hydrogen as hydrogen fuel cell vehicles as an alternative to BEVs in the future. Is that right?
Yes, absolutely.
Okay. So I think it's a really interesting question. I think hydrogen fuel cell vehicles have taken a bit of a back seat over the last 5 or 6 years as EVs have been the talk of the town in the transport world, and have obviously been gaining traction in more mainstream markets over the last few years. There are a lot of benefits to fuel cells, hydrogen fuel cell vehicles, in my opinion. They are potentially a lot lighter. They can recharge a lot more quickly. And in an ideal world, I think I could see there being a lot of points of competition with EVs. I still think that the infrastructure required, the transportation and storage of the hydrogen is such that it will be challenging for it to become truly mainstream for personal vehicles. You almost need a degree of kind of mass agreement from multiple supply chains that we are going to do this for it to ever happen on the scale that will be required. So I think that as battery technology improves, despite its inherent failings versus hydrogen on weight and a number of other points, I think a lot of those benefits will be eroded, and hydrogen fuel cell vehicles will not take off in a mass market way. Apart from in certain environments where you've got clear route planning and can potentially quite large volumes. So for some types of public transport, for some types of logistics, I think it's possible. However, that is all just my opinion, and I think it's quite important to note that with almost everything we do across all of our sectors, but in mobility in particular, we do try to be agnostic on those types of technologies. So if you look at car sharing platforms or models along those lines, you don't necessarily need to place a bet on who's going to win in that particular technology battle.
Great, Chris, thank you very much. We are a good bit over time, so I'm going to draw our panel discussion to a conclusion there, but I would like to absolutely thank my esteemed colleagues at the Investment Committee for their time and thoughts. We will be running a series of events over the next few weeks of the campaign. Next week, we have a Meet the Portfolio Company event. And the following week, we have another of these Build Back Better Investment Committee events. And we will run events throughout the campaign on Thursday evenings, an opportunity to meet both the Investment Committee and the portfolio companies. So thank you very, very much for talking to us, Investment Committee. Thank you very much to the participants. Today is the launch of our fundraise, so please do take a look at that at cedars.com/SA4 and do get in touch with us should you have any questions at all about that fundraise. Thanks very much.
Thank you.
Thanks.
Thanks, everyone. Thanks, Susanna. Cheers all. Have a good evening.